It looks like, well, they opened them up, but they're actually low. Well, it's a kind of a weird because they rallied them so much. They closed with such a high premium that this is actually right where they closed, right here, essentially.
Yeah, effectively.
Maybe a buck or two lower, but they closed with a massive amount of premium on Friday. It's the most, I think, the most upside juice. Like when they close underwater, sometimes we go, wow, they closed them, $10, $15 underwater. Is there sound right now? Please check that.
We're checking that right now with Frank.
There is sound.
There is sound? Okay, because I'm getting messages from people saying no sound, Josh. But anyway, we haven't had a close with that much premium in the S&Ps. So what happens is at 3:00, 3:01, essentially the cash markets close. And then from 3:01 to 3:15, the indexes trade, the futures trade. And what happened on Friday, the futures were trading down around, let's just say the S&P futures were trading down right around 6,400, 6,406 or something like that. And they rallied them from 6,406 to 6,425 we call it on the curb in the last 15 minutes when the cash markets closed, but when the futures market's still open. So what they're doing right now is they're giving back a little bit. Hey, Josh, I'm getting a lot of emails saying there's no sound. Just as an FYI, I'm just talking to our producers just to make sure. Yeah, if anybody out there is getting sound and you can hear me, just let me know. But Chris, are you getting any emails?
I have not, and Frank told me that the YouTube chat is fine. So
okay,
we're gonna.
Well, then we're having issues somewhere.
It's good. We corrected it.
Okay, good. Okay, thank you. So it's been a long time since we closed with that much premium. Now, the first thing you're saying, well, what does that mean? Is there anything to that? And the answer is probably not much, except that's when markets tend to make bottoms and tops. We make bottoms when we close way underwater. We make tops when we close, with a crazy amount of premium. And I don't know. I mean, it's just something to throw out there.
Well, let's talk about this market. I mean, last week we basically closed on the highs in the equity indexes. It's a really strong end to the week. We rebound after the previous Friday's falling apart in the NASDAQ, the S&P 500 around the jobs data. So now we're starting this week near the highs. First things first, the earnings calendar here. I look at this week ahead and it doesn't resemble anything like what we've seen over the past 2 or 3 weeks. What's your feeling on the state of play here as we start making our way through the middle of August?
Well, I think the earnings, clearly the earnings are, don't. I mean, we're long past the earnings at this point. So I wouldn't. I'm not that focused on earnings anymore. I mean, all the big kids are out, and the ones that are left, you've seen some absolutely horrible earnings numbers in the last couple of weeks, and it hasn't even budged the stock market. So when you start to think about it in those terms, you're like, oh, okay, well, I mean, if you can't hurt this market with horrible earnings, it's not going to be earnings that take the market down. And we have clearly, we're clearly past earnings.
Okay, so then the only earnings that's coming up around the corner would probably be NVIDIA towards the end of the month. We have to wait.
I think that's fair. NVIDIA is fair. I mean, NVIDIA is, the one of two $4+ trillion stocks. So yeah, I mean, is Apple $4 trillion now? I'm not even sure. Maybe it's one of three.
May have gotten back there with the recent move. Apple trading up from lows just north of 200 last week to now 229.35 a share.
Yeah.
Tom, I want to stay focused on NVIDIA and AMD though for a quick second here, because while their earnings aren't out there was this piece of news that came out maybe 30 minutes ago that AMD and NVIDIA are going to be paying another tax effectively for any sales of chips to China. There's the debate, of course, is this a good thing or a bad thing? Ilya and I and Josh, you were chewing on this before the show, and I think it's actually an interesting talking point here. I'm just going to go out there and say I think this is bullish, not because I'm me and I'm a bull and Ilya's the bear, but the government, Trump is clearly prioritizing U.S. corporations' market access over actually any significant trade decoupling. And so if you're NVIDIA or AMD, yeah, you may have to pay 15% or 20% to the US government that you weren't intending, but it's better than not having any sales to China at all.
Actually, I think it's a incredibly dangerous direction, and it sets the, it goes very counter to the concept of free markets.
Okay.
And I think that it is anytime that you try to force trade policy like this, the end result is it is not going to be bullish. So no, I'm going to disagree. I'm going to say, listen, if there's a gap up in AMD or NVIDIA, especially after the crazy rallies that they had, NVIDIA's basically at an all-time high, and AMD, which missed on earnings and then bounced up, late last week. If you get any kind of rally in these stocks based on a news-based rally, I would just sell them to your hands, please. I mean, I just mean that. I don't think I just don't think it's going to be news related that pushes these stocks higher at this point. I like when they ride. I like when they go higher and there's nothing else there. I mean, look at NVIDIA. It hasn't had a downtick since April. I mean, at this point, do you really think there's a piece of good news that could come out that could send NVIDIA stock higher? I mean, it's already trading at such a ridiculous rich premium, given that it's a $4+ trillion company. I mean, if you're long NVIDIA, unbelievable ride. And if you've been short NVIDIA, it's been absolutely impossible. But if you've got no position on NVIDIA, would you buy it here?
Yeah.
You're out of your freaking mind. You are absolutely insane. You're nuts.
Okay, but this is the question I think a lot of traders are facing, and you probably experienced this too, maybe not. But I found for myself, the most difficult thing to do is just to hang on to a trade that continues to work and work and work, and not let myself fall into this has gone too far. What makes you think that? It's doubled since the April low. Is that enough to make you say this has gone too far too fast?
NVIDIA? Yes.
NVIDIA.
Yeah, I mean, it's common sense. It has nothing to do with anything else. It's just in a world of free markets, something that, it probably got too cheap in April and it's too expensive in August. I mean, there's no other story to tell. Stocks, that's what the emotion of the stock market does. The stock market doesn't have like this middle ground where everything is fairly priced. The stock market has this, the stock market loves to push things to the limit. So the stock market loves to essentially take things down, where they get awfully cheap. And that's how you capitulate, right? Things get too cheap, they eventually capitulate. And then things get too expensive and they eventually capitulate. Because at some point, either the shorts are going to capitulate, which always puts the top into place, or the longs are going to capitulate, which always puts the bottom in place. And the stock market rarely trades, wrapped around fair value. I mean, it would be really hard pressed to think that that anybody here would be like, okay, well, I think it's time to open up, new positions in NVIDIA. Could you get $10 higher, $20 higher? Sure, but I don't like it.
Let's talk about the Mag 7 broadly speaking here. Yeah. I saw a really interesting report over the weekend. There's a lot of concentration risk in the Mag 7 right now. Nowhere near railroads. When railroads were being built out, they were 68% of the top line index. The Mag 7's closer to 33%, as it were. But if you were to reconsider the Mag 7 as conglomerates and you were to break them down into their biggest components, you actually have about 30 individual companies that make up the Mag 7. Outside of the Mag 7 names, the earnings ratios for the rest of the market are still below 20 PEs, closer to like a 15 PE, in fact. So how do you reconcile those two things? I know a lot of people out there are saying in traditional financial media, this market is overvalued, but it really only seems to be a core group of companies that are overvalued. Do you think that we're in a bubble market right now?
I think we're in a frothy market. I think bubble is very different. So
what's the difference?
Well, when I think of bubble, I think of 2000. And I felt like 2000 was unsustainable, was completely ridiculous because you had a lot of really crappy, cheap stocks and no-name companies that were just adding a .com. It was almost meme stock. When we saw what happened with GameStop and in 2021, when we saw what happened with GameStop and AMC and all the other crazy meme stocks, everybody in the world knew that was unsustainable, and they went back to where they rightfully belong. In 2000, we all knew that was unsustainable. In 2025, the Mag 7 or the Mag 10 or the Mag 15, whatever you're talking about here, this is a different this is a different animal. And I'm not saying that they're not frothy or anything like that, but these are real companies. These are not, Books a Million and WorldCom and whatever else it is, like all the crazy companies that were picking up, billion-dollar valuation, picking up $1 billion an hour and stuff like that. This is a different world. I thought.
Can I comment on that? $1 billion an hour.
Yeah.
Today is actually the anniversary of Netscape's IPO.
There you go.
The Wall Street, and I saw the Wall Street Journal article today that was published on the day of their IPO. Their lead is really interesting. It took 40 years for General Dynamics to grow to the $2.7 billion market cap that it has in the stock market today. It took Netscape less than 1 minute the day of its IPO. That's the kind of bubble we were in. Anything with a .com through the roof. So I don't know if we're there yet.
I said I think we're frothy. I don't think we're there, but I can tell you that it was very different in 2007 also. In 2007, the couple of things you have to look at in the market, I think to get to a point where you think you're in a bubble, I think in 2007, towards the end of 2007 and towards the kind of the middle of 2008, before we had the huge meltdown, we had volatility trading, in the 9 handle. So the level of complacency, people were just blindly selling volatility, and they were just buying, doing covered calls, closed-end mutual funds, basically doing, credit default swaps for an extra couple of percent. I mean, the mentality was it was impossible to lose. And then, of course, we have this massive meltdown. I think right now we are in a stage where we are incredibly frothy. Now, what scares me the most is not NVIDIA trading at $4 trillion. What scares me the most is an IPO coming out at $33 and trading at $133 the next day. That's not a function of, it's really not a function of the investment bank pricing it wrong. Now, they want to price these things cheap so that they can give back, a little bit of money to their, to their best customers. They want to price them cheap because the insiders can't sell for 6 months anyway. So they don't really care, because the fact that it pops up, whatever, the low price doesn't hurt them at all. It's a better story. It's better PR. But there's no way they misprice them by 4 and 5x. And what you're seeing last week with things like Firefly and Circle and CoreWeave and all the other stocks, that there's probably I would say 7 or 8 of them that have come out recently. And you can even throw, to a certain extent, you throw Palantir and a few other things into that list. But the bottom line is that that's the closest thing to a bubble and a huge red flag that we have is what's happening in the IPO market. I wouldn't say what happened last week in Apple, or I wouldn't say what's happened in AMD or NVIDIA or, Microsoft or Meta. I wouldn't call that a bubble. I would just call that incredibly frothy. I don't like the pot odds up there. But the other stocks, those scare me a little, Chris. Those IPOs, what's happening in the IPO market right now is almost, I told Tony on Friday, I called this asymmetric speculation, meaning that the thought process is, you know what? There's so much speculative money on the sidelines that just they don't want to buy, IBM. They don't want to necessarily buy, some stock that may go up by 5, 10, 15, 20% next year. They want some stock that's almost acts like a cryptocurrency. They want some stock let's call it like Firefly, where they think they can buy it at 50 and next day it could be up 10 or 15 or $20. And then in 2 weeks, it could be 110. And that is the type of market that should make everybody a little bit nervous, or at least present a red flag.
So before we bring in Ilya to join us for the rest of the show, I do want to get your feelings on ETH, BTC, and maybe the crypto universe this week. I can't help but notice after this weekend, there's a nice little pop here. BTC is up over 2%. Ethereum futures 3.8% higher, back over $4,200 an ounce. Is this part of the everything frothy argument?
Yeah, I think ETH is for sure part of the everything frothy argument. I think that, there is so much premium. Well, first of all, it's weird because all weekend Bitcoin was basically down a little bit. It wasn't even up. Like it just tonight when we opened a few minutes ago, Bitcoin rallied 2,000 points. I mean, I looked at it before and it was trading in the 17 handle, half hour before we came on. So it just rallied 2,000 points in the last, the last 30 minutes or $2,000. I think the argument for ETH here, well, remember, it's playing a lot of catch up, but I still think it's gotten incredibly frothy. And I'm long ETH. Like it's my biggest cryptocurrency long. So I haven't sold any yet tonight, but I'm just watching it kind of surprised by the action in there, but pretty wild. I think the whole stablecoin market is overpriced. I think that the cryptocurrency market is overpriced. I think that it's interesting to see, how within a week they brought Coinbase from ridiculously overpriced and they brought it down by 25% to get it more in line with what its value should be. Same with to a lesser extent, MicroStrategies. But I guess my point is, I think that the premium in some of these crypto stocks was out of control, and now it's gotten maybe a little bit better, but it's still really rich. Still really, really rich.
It's incredible. Coinbase has lost 25% of its value over the past, 2 weeks? And it's still at 300. I mean, the stock's had a great run this year. So talk about the froth.
But I consider Robinhood a crypto stock, and Robinhood is, on its highs at 115. So and not every crypto stock has really, has sold off. Coinbase did because the exchanges getting into the listed spot business cannot be good for crypto exchanges. But on the other hand, a crypto brokerage like Robinhood or I'm trying to think who else is public. That's probably the only one that I know of that I could say is like a public one. That won't hurt them at all, but it will hurt the Coinbases of the world and things like that. That's all. And there's not another stock out there like Coinbase, really. So there's not a lot of comps to go by.
Sure. Josh, why don't we bring Ilya in here to join us for the second half of the show? Tom, while Ilya's coming in and joining us, let's switch our attention over here to the bond market rates so we can get our favorite Fed commentator to chime in.
Yeah, sure.
Last week, a little bit of softness. There was some wonky price action earlier in the week. According to and I verified this with someone else who was looking at similar feeds. They think that someone was putting in UB trades last week at the yearly open and fat fingered it, which is why we had that weird action in ZB, ZN, UB late last, Wednesday. But outside of that, this is a market that has low volatility. It's a 2.7 IVR. The MOVE index, the measure of volatility for the bond market based on listed option prices, is now at its lowest level since January 22. So Tom, let's start with you. What do you see here with bonds this week, given that the vol is basically MIA?
They were super crappy all week. It's funny. I thought they'd be a lot stronger this week, and they simply weren't. They were heavy all the way through Friday. And it looked like they were going to kind of have a little bit of a breakout, and they just stayed heavy the whole week and closed down, around $15 and that's kind of on an uptick on the close on Friday. They were like high 14s in that range. I mean, I went home long bonds. I think the play is you've got to stay long them no matter what here. But, it's been an easy call so far because you haven't taken any heat. But, it's been, compared to stocks, it's been a crappy long.
Ilya, what's the move here? Bonds are fading off. We'd be remiss not to mention there is some important data. There are important data points over the next few days regarding bonds in the treasury market. Do we trust the CPI data that's coming out this week?
So first of all, hello. Secondly, of course we do, because as we've said over and over on Overtime, and other places we've discussed it, the markets just need a yardstick. It's not important that if the yardstick is academically good or bad, unless it's so crazy, I suppose, that it's no longer a valid yardstick. But as long as everybody agrees that the yardstick is the yardstick and everybody's looking at the same number and trading off the same number, it doesn't matter. This is why when people start to bang their fist about the truflation measure or whatever else other alternative inflation measure, the response is always the same. But will the Fed set policy on that basis? No. Will the markets value assets on that basis? No. Who cares? It doesn't matter. So I think, of course, the markets are going to take the inflation numbers at face value, and then everybody will read the same numbers and see what they find in them. The expectation, of course, is that we're going to get inflation continuing to go up, a 3% reading on the core number expected, 2.9 on the headline. That's another increase and higher than we've seen in quite a few months at this point. And as far as the bonds go, it's pretty straightforward. The bonds are in a trend that points up near term. The sort of bigger picture from April's lows is a choppy range. But from the lows in July, the trend is up. In fact, if you, to your point now on the screen, if you look at all the way back to the May lows, the highs are getting higher and the lows are getting higher. That's an up move by definition. It's slow, it's choppy, it's incredibly annoying, but that's the bond market. It's slow and choppy and doesn't get to spots quickly. And frankly, if it did, you should be scared, because this is not the market that you want to go fast, especially at the long end maturities. Something is wrong if the 30-year is swinging like a meme stock, like it did in April, say. So
we don't want that.
Nobody wants that. So it's annoying, but the trend is there. And I've been in it for a month. I gave myself tons of duration. I still have like 40 days of duration left on the verticals I have on. So I'm just going to sit.
Mr. Sosloff, let's keep it rates adjacent here and talk about gold. We had to move higher gold last week. We did close at a new all-time high, only to learn that it was tariff-induced and therefore it was coming back out of the box Friday afternoon. Volatility here is perking up a little bit. We had a high of 31.4 in the IVR on Friday, but we're settling in here at the start of this week at 19.4. What's your sense on gold? Is it been long enough? It's been 4 months now of choppiness. Do we get away from the choppiness? Or do you think that maybe leaning on the directionally neutral is still the best bet?
Yeah, I think directionally neutral is the best bet. I think it's been the best bet. I think it stays the best bet. I don't see any reason to do anything in gold except, for the last month and a half, the first after April, the first month or so was really hard in gold because vol didn't come in at all. But then for the last month and a half or 2 months, vol's been coming in just about every day. So gold has been a short vol play, hands down, for the last 2 months. There's nothing else there. Like, you don't have to talk about it from, directionally, it doesn't, who cares? It's been completely a wide strangle, short vol play, whether you do it in GLD or GC or even trading SI, it doesn't make a difference. Everything has been straight short vol. It's worked. Now it's getting a little cheap. So now you got to be, now you're probably pretty close to covering, but that's where we are right now in the world of precious metals. I also think that you still got to stay away from copper because it's just not a liquid enough market. It's been the option marketplace is just not liquid enough. I don't think it's going anywhere now, but I just don't think the option market's liquid enough. And you don't want to get stuck in something that's just has no liquidity. So I think the metals market right now is still a short vol play, but it's getting to the point where it's almost in cover territory.
Ilya, before we go over to you, Tom, do you have a different feeling about the miners, GDX, GDXJ? These do have a little bit higher vol readings than the metals themselves.
They do, but I can't make any money in there. I've tried for 10 years.
Okay.
I mean, I cannot. I know that they seem higher vol, decent liquidity. You kind of want to trade them because they're cheaper plays. I just can't seem to squeeze any money out of them. The big moves in there seem to overwhelm because they're cheap stocks. Like that last rally up in GDX, like I didn't have anything on in there, but I can only imagine for people that did, it's almost indefensible. So I don't know. I do not have anything on in there right now. I prefer to stay away from GDX and GDXJ.
Fair enough. Ilya, gold last week, we saw it bounce up. You very appropriately mentioned to me, don't get too excited, Chris. The spot market's not following futures. It's going to come back in.
That's
right. You were correct. Your short call spread, still holding on to them as we enter this midweek of August.
Yeah, I mean, I approached this, as Tom was saying, from the short vol perspective, but I had a little bit of direction in it, in that when we were toward the bottom of the range, I was short puts. And as we started to kind of fail and find a top of a range, I was short calls. But essentially, I'm just short vol and looking not to lose any of the premium I receive and just be a little bit defensive. So at this point, we're at the top of a range. I still have tons of duration on these short calls. If it oscillates back into the range, I'll add a little bit of price direction into the position. Okay, fine, cool. But I think, to Tom's point, there's a lot of vol that's already come out of here. And if I wanted to get directional, my bias is on the long side. I just don't think we have a breakout to do that with here. So I probably will be unwinding this thing. If it swings back into the bottom of its range after failing again near the top last week, I'll probably start to look at reevaluating and maybe getting on the short put side again. This time, maybe with a little bit more duration. Again, I've been doing 60-day and 70-day just because these markets are so choppy, and I kind of want to dilute my delta exposure up front and sort of let them figure things out. So I'll probably switch over to that side again, because if we are going to break out, I think it's higher.
Tom, let's round this out with the currencies and take it home. Dollar last week got slammed again. It's finding a little bit of footing here. The yen's not really bouncing back. It's near 0068. The euro itself, though, you're seeing it hang around 117. I can't help but notice the currency futures. There's some good vol in there. Aussie 39.3, Canadian dollar 48.9, euro 43.8. What's the move for FX here, Mr. Sosnoff?
It was a massive move up. That was a challenge last week with those 2 days of rally in the euro. I'm keeping my position pretty tight here. Now, when I say that, I have a lot of currency positions on, so I'm a little weird. I'm not like I'm probably not like the average trader here, because I have just I don't want to say I'm overweighted in currencies, because I'm not, but I just have a bunch of currency positions on. So in the euro, I'm trying to stay relatively flat delta here, because I think that every time it has a nothing day, and they take a lot of juice out of it here, because it does still have some pretty high IV, and it's one of the only kind of really good trading vehicles in the currency world. So I'm trying to stay short a bunch of premium in 6E. In the yen, I'm never ever going to have any position on other than long yen. And so far, that's continued to work. It hasn't gone anywhere. It had a nice rally a couple months ago. It's kind of sat around here. It's in that 67 to 69 range. Occasionally gets up to 70. It may get down to 66, but it's been trading in that range now for what feels like basically all of 2025. I think it's a short put play. I don't think you ever touch anything in the yen. I don't think you get too cute in the yen. Everything else, every other currency, I don't think. Like, I'm long British pound, I'm flat euro, I'm long yen. So I guess on balance, I'm a little short US dollars, but I also don't think, Chris, unless you're trading the spot markets, I don't think you can trade the option market in the Aussie, in the Canadian dollar, in many of the other currencies. I don't think there's anything there. Can't trade the peso. Like there's
No,
nothing.
not the peso. You got to.
No, not the
If you're trading the currency futures, Ilya and I talk about this on Futures Power all the time.
Yeah.
You don't want to Hotel California yourself into a trade, so you got to check your open interest, your trading volumes.
Yeah,
It doesn't even matter. There's nothing there. Like I trade them all. I trade everything that the CME offers, basically, that's even remotely liquid. And I'm telling you, the Aussie and the Canadian dollar are like pulling teeth. And even the British pound is a tough one. I mean, the yen you can usually get filled in, and the euro's the only one. So you got to be, just there's not a lot to talk about, because you can only talk about what actually trades. And those
and of course, people can go to TastyFX, right?
I don't trade the options. I just trade the micro futures outright. And those feel fine, but the options are thin, other than the euro, of course.
Ilya, let's round this out on inflation and rather oil prices here real quick. We have a little bit of a drop here at the start of the week. We've been humming around between 63 and 65 for the better part of the last 2 months now. Today's August 10th. The Israel-Iran war is over on June 23rd. So we're not quite there at 2 months, but since that ended, it's been $63, $64 a barrel. You and I have done quite well here betting on it being $63, $64 a barrel for the past nearly 2 months.
To the middle of the range again.
Do we still make that bet this week?
I am not really interested in having neutral bets here. It's just not interesting. Like there's 23 IV. If this thing is going to bounce here or it's going to break, I'm going to get directional, and then I'll have a crude position on again. I basically got out of this once the big spike from 76 fizzled, because you and I talked about this. That was a crazy spike. It didn't make any sense. So we've faded the geopolitics there.
Classic Radigan trade.
That worked. As soon as it settled back on the on that range in the middle, that sort of axis around 63 and change-ish, around which it's been oscillating for months now, between 76 and 54 or so, I'm out, and I haven't had a position since. I'm going to wait. My bias is bearish, but it's got to take out some of these levels here and show me that it's actually going to get on the other side of this center line, and then, okay, let's go. But in the meantime, the risk reward's not there.
Take us home, oil.
Well, I don't have an opinion on oil. I just don't. I don't even care. I think that this market right now is an equity market. It's all about equities. I mean, the bonds are a one-trick pony, and that's your other $50 trillion marketplace. I don't think you start talking about crude oil, even digital assets and different asset classes like currencies. I think these are all really nice, like kind of complementary trades or supplemental trades, but I don't think any of them mean, this is, I just don't think they mean anything. I think this is either a stock pickers or stock traders market. And I think you're going to see the majority of the money flow and basically all of the trading opportunities are going to take place in the various equities. I mean, these equities are bigger than, these equities now are essentially bigger than entire sectors. And so this is an equity marketplace. You can pick any one of the top 20 equities, and it's a more interesting trade and it's a more liquid trade than virtually, any commodity. That's why you're seeing huge volume, huge notional volume in all these equities and kind of really light volume in all these futures markets. Because this is, if you're talking about a speculator's market, then this is an equity marketplace and nothing else. So I think that what people really need to look for is, is there something out there that gives you a sign that, hey, maybe this has gotten to the point where it's ridiculous. Maybe this is cheap relative to that, or whatever it is. Or maybe you got a hunch and you want to bet, like you used to say, well, I got a hunch in Apple, but I'm not getting paid because Apple didn't have a $2 move for 2 months. And all of a sudden it has three $10 moves, 3 days in a row. It doesn't matter what you do. So that you could make money on it. So I think that this is going to be a stock players market into, at least into October.
And by the way, that basically means that you're into a kind of risk on, risk off environment where you're looking
100%.
at where you're looking at stocks. They become your barometer for risk on, risk off.
100%.
Chris and I, you and I, we've talked about this idea that you're going back in the second half of the year to a more risk on, risk off classic, where the bonds and the dollar become anti-stocks, gold fits in there somewhere, and you get into a very kind of familiar dynamic where if the market decides, oh, risk on, everything swings this way, and if the market decides, oh, risk off, everything swings the other way. And so that's why I'm still a little bit bearish stocks and bullish dollars at the same time. I don't think it's a yield story or a Fed story even necessarily. It's more a risk on, risk off story.
So we're going back to the classic 60-40 stock bond passive portfolio, Tom. Obviously, I
That's
can.
if stocks go up, not if they go down.
Give us the final closing thought for this week, boss.
I just told you, I think it's a stock traders market. I think this
All right.
week, no, this week though, just talking about this week,
Sure.
historically, because you like that, you like that historical stuff. This is generally a very soft week. It's a soft expiration. Generally, August expiration has bigger down moves than up moves, and it tends to be, going into August expiration is when people start getting, I don't know, I think they start getting serious again. And so I'm expecting a lot of chop. And because we closed at such a rich premium on Friday, like the biggest premium we've seen in a long, long time, I don't like them.
Well, you heard it here, folks. We have a market that Tom Sossoff doesn't like. No earnings this week. Ilya and I are going to be chopping around in oil. Maybe he gets directional. But that's it for First Call. Tom, we resume programming overnight in London, 1:30 Central Time, 2:30 Eastern Time. You guys, of course, are back for First Call, 7 a.m. Central, 8 a.m. Eastern. So programming continues tomorrow morning.
And if you're
excited
in
to see
Seattle, we have a live show starting at 6:00 tonight. So that's in about 2 hours. So 6:00 West Coast time. So if you're out there in Seattle, go to the Crocodile and see Katie, Nick, and Mike.
Awesome. Everyone, thanks for watching. This has been First Call. Good luck trading.
A special treat for you on Trade Live with IG. A better, sexier model. More joins us on the show for that Friday vibe.
For the Friday feeling. Welcome to the show, everybody. How are we? How are you getting on, Angie? Well?
All good. Also, a call out to Pete Ward. It's a beautiful day today, isn't it? Look at that.
Yeah, I've heard it's going to be a warmer day because it's been a bit of a rough couple of weeks weather-wise, but I've got my linen shirt on.
I know.
I've got the Friday feeling.
I know Sam Peach. Call out Sam Peach on the desk as well if you're listening in. Also got that linen shirt thing going.
Yeah.
You look like you're about to head off to Marrakesh.
Well, I'm going to go to Camden. Not quite Marrakesh. Not quite as glamorous as Marrakesh. I'm meeting a client this morning for a quick coffee.
Nice, new client? Old client?
Someone that's been with us for a little while, but my first time meeting him, and so that'll be good fun. So yeah, it was difficult because it's Friday. Camden High Street's not exactly the most formal place, so I thought kind of settle somewhere in the middle, nice Friday shirt, we're good to go.
Okay, nice. Let's talk about
Hello, everybody. We're back. Sorry about that. A couple of technical problems on a Sunday night, but we worked them out. Apologize. Mr. Vecchio, how are you?
Mr. Sosnoff, I'm doing well. Very beautiful weekend here in New York.
It was nice here in Chicago. It was sunny and hot as hell, but I'll take that. No issues.
Wasn't that warm here? Like